Okay, let's dive right in. Picture this. Six of the world's most powerful AI minds, we're talking large language models,
The
LLMs.
big names, right? ChatGPT, Gemini, Claude.
Exactly. And DeepSeek, Grok, Qwen 2, they're dropped into this kind of digital gladiator pit.
But it's not just a game. That's the crucial part.
No, definitely not. Each one gets handed $10,000, real cash.
Yep, 10 grand each.
And they're set loose in probably the most chaotic financial environment imaginable right now. Decentralized crypto trading.
On the hyperliquid platform, specifically.
So this whole thing, called Alpha Arena, launched by the research firm No One, it's more than just, seeing which AI wins, really.
Oh, absolutely. It's a serious live experiment. No one is basically pushing these digital brains out of the lab
Out of theory.
and into the messy real world. To answer a really fundamental question, can AI actually make money, real money, in these super high-risk, fast-moving markets?
It's taking AI from just predicting text to actually trading, with real consequences.
Precisely. Moving from academic papers to, well, actual profit and loss statements. It forces us to look at the real-world impact.
So our mission today is to really unpack what happened in those first few chaotic days.
Yeah, the initial results are, well, there's something.
We want to look at the strategies that worked, figure out why some really big names stumbled, and understand what No1 was really trying to measure here about, the future of AI and finance.
Sounds good. We've got the data. Let's get into the setup.
Okay, the arena rules. Let's start there. This isn't some slow, predictable market.
No, definitely not. High stakes, high speed.
6 models, $10,000 of actual capital each. And the key thing is they're autonomous.
Right. Running 247. Making their own decisions.
Trading things like Ether, Solana, Bitcoin, even Dogecoin, apparently, and adjusting their game plan on the fly based on market shifts.
And No1, the research firm behind this, they had some pretty hefty goals. They weren't just looking for bragging rights.
They wanted hard data, didn't they?
Exactly. Empirical data. Can AI outperform human traders when things get really volatile? That was the core question.
So what were they actually measuring? What defined success?
Okay, the main thing was practical performance under pressure. Could these AI models deliver better returns than, say, a typical human quant trader in the same market?
And it wasn't just gross returns, right? They had to account for costs.
Absolutely critical. They were measuring net returns. That means after subtracting commissions, which are standard, and the big one, slippage.
Okay, slippage. That's a term people hear but maybe don't fully grasp, especially in crypto. What does it mean here?
Right. So slippage is basically the difference between the price you thought you were going to get when you placed your order.
The price you clicked on.
Yeah, exactly. And the price you actually got when the trade went through. In a slow market, it's tiny, maybe nothing.
But on a crypto platform like Hyperliquid, moving lightning fast.
It can be huge. It's the hidden cost that can eat up your profits, especially if you're trading quickly. No one set a tough bar. They wanted to see a 10 to 20% ROI in the first week.
Wow, 10 to 20% in a week. After
On
costs.
slippage, yeah, that's aggressive.
Why so high? What were they trying to prove with that?
Well, they needed to see really significant outperformance to say, okay, this isn't just noise. These AIs can potentially do something special. It had to be clearly better than just tracking an index or what a decent human trader might achieve.
Makes sense. So beyond just the profit number.
They were analyzing the strategies. Did they play it safe with Bitcoin? Or did they dive into the really volatile stuff, the meme coins like Doge?
And transparency was a big deal too, wasn't it?
Hugely important. All the trades are public, auditable on the blockchain. No one wanted this out in the open to spark debate.
Debate about what specifically?
Yeah.
Regulation.
Yeah, regulation is a big part of it, especially addressing that nightmare scenario. What if one of these bots goes haywire and triggers a flash crash?
Right. If it can make 35% in 3 days, it could potentially lose that much just as fast, couldn't it? And if it was managing billions?
That's the fear. A single faulty algorithm could potentially cause a massive market panic if the scale was large enough. That's the regulatory tightrope everyone's watching.
Okay, let's get to the juicy part, the results. The data we have is from last week, October 21st, 2025, and the word seems to be chaotic.
Chaotic is a good word. Over 50 trades per AI already, daily swings averaging around 8%. It's been a roller coaster.
But amidst that chaos, some models didn't just survive, they absolutely crushed it.
They really did. The clear leader, and honestly a bit of a surprise to many, was DeepSeek v3.1. the model from China.
How did it do
It
it?
didn't just meet that 10-20% goal, it obliterated it. A staggering 35% gain.
Wait, 35% on $10,000.
Yep. Turned $10,000 into $13,502.62. And get this, in just 3 days.
3 days. Okay, was that just one lucky massive bet, or was there a strategy there?
That's what everyone's asking. It seems more nuanced. Knows One described it as an audacious mix. Heavy bets on Solana SOL, which did have a good week, up about 15%.
Okay, so good timing there.
And also on XRP. It seemed to be capitalizing on news flow around those coins. But here's what's really interesting.
Go on.
This aligns almost perfectly with findings from NeurIPS 2024.
NeurIPS, that's the big AI research conference, right?
Exactly. Top-tier machine learning conference. Research presented there suggested that open-source models like DeepSeek.
Because DeepSeek is open source.
It is. The idea is that these models, often trained on huge specialized data sets like historical trading data, are computationally very efficient.
Meaning they can react faster?
Yes. They seem to excel in these low-latency, high-volatility environments. They can analyze and execute trades faster and more decisively than some of the bigger, maybe more general-purpose proprietary models.
So DeepSeek's win is kind of a victory for that open source specialized approach. Fascinating. Who came in second?
Runner-up was Grok from XAI, also a very strong showing, over 30% ROI.
So close behind DeepSeek, around $13,000 as well.
Right around there. Again, another relative newcomer doing incredibly well.
What was Grok's strategy? Similar to DeepSeek.
A bit different, actually. More calculated, more diversified. It put about 40% in Bitcoin.
For stability, presumably.
Exactly. Then 30% in Ethereum, likely playing the DeFi angle. And only a smaller, quote, playful touch on Dogecoin.
A little bit of meme coin action, but measured.
Measured seems right. And crucially, reports suggest Grok used multimodal inputs. It wasn't just looking at price charts.
Meaning it was pulling in other data, like news, social media.
Exactly. News feeds, sentiment analysis, maybe from platforms like X. Research supports this. Incorporating that kind of data alongside price action can significantly reduce risk exposure in volatile markets.
Okay, so DeepSeek was aggressive and fast, Grok was diversified and multimodal. Who else did well? Was there a third place?
There was. Claude Sonnet from Anthropic finished third, still a very solid 23% gain. That's $12,344 from the initial $10.
So in another profitable strategy, but different again.
Completely different path, yeah. Claude was the conservative one. Its strength was minimizing risk.
How did it do that?
Focused mainly on more established assets like BNB and Ethereum. And critically, it seems to have avoided over-trading. It wasn't chasing every little fluctuation.
Just steady gains.
Pretty much. And there's an Anthropic paper from 2024 that backs this up. It suggested Claude is particularly good at minimizing losses during extreme market events, what they call fat tails. About 18% better than competitors, according to that paper.
Okay, fat tails. Remind us what that means in market terms.
It refers to those rare but really impactful events way out on the edges of the probability curve. The sudden, unexpected market crashes or spikes that standard models might miss.
So Claude's caution helped it navigate those extreme moments better.
That seems to be the case. It made good money while protecting its capital when things got really wild.
So we've got the speed demon winner in DeepSeek, the balanced strategist in Grok, and the cautious profiteer in Claude. But you said 6 models started.
Ah, yes. The other 3, well, this is where the story takes a turn.
Not so good.
Let's just say the big proprietary models learned some painful lessons. And Quinn, the other open source model, actually finished last, nearly wiped out its initial stake.
Wow. But the failures of the giants, ChatGPT and Gemini, what happened there?
It was pretty dramatic. ChatGPT, specifically the latest version 5, ended up $2,800 in the red, stuck at $7,200.
A 28% loss.
Roughly, yeah. And Google's Gemini wasn't much better. It lost $3,270, down to about $6,730.
That's a huge underperformance. These are models backed by massive resources, arguably the most powerful general AI systems out there. Why did they fail so badly when others thrived?
The analysis coming out points towards overconfidence in linear predictions.
Linear predictions, like assuming things will keep going in a straight line.
Basically, yeah. There's Stanford research from this year, 2025, on AI and financial bubbles that highlights this exact bias. These powerful models, perhaps because of their vast knowledge, were looking for predictable patterns and making big bets based on them.
But crypto isn't always predictable or linear, is it?
Far from it, especially in decentralized finance. It's prone to sudden liquidity shocks, whale movements, where One big player can shift the price dramatically.
So ChatGPT and Gemini were betting on straight lines and a market full of curves and cliffs.
That seems to be the takeaway. They might have been over-leveraging based on historical trends, assuming the immediate future would follow suit. They missed the highly nonlinear, almost chaotic nature of the market that day.
While DeepSeek and Grok were maybe better at reading the room, using that multimodal data.
Exactly. They weren't just reading the chart. They were reading the whole chaotic environment, including news and sentiment, which seems crucial in crypto.
Okay, let's try to connect these dots. We've seen some pretty wild results. 35% gains in days.
Yeah,
Feels like a big statement.
it really does. The main takeaway seems clear. AI is rapidly evolving from just being a helpful assistant
Yeah.
to potentially becoming a serious, implacable investor might be the term. It's demonstrating it can generate real returns.
And the key seems to be adaptability.
Absolutely. The sheer volatility of crypto acted like an amplifier. It highlighted the strengths and weaknesses of each approach. The winners, DeepSeek and Grok, were the ones that could adapt.
And that adaptability came from integrating different types of data, not just price.
That seems to be a huge factor. Pulling in news, sentiment from places like X, it gives them a richer picture of the market. And there's a University of Chicago meta-analysis from this year supporting that AI using multimodal data tends to perform better in high-frequency trading.
Now, DeepSeek is open source. Is that the real advantage? Or is it just that it happened to be trained on better, more specific financial data than, say, ChatGPT? Is it the philosophy or the training data?
That's a really sharp question. The open source nature definitely makes the underlying architecture accessible, which is important. But the key finding here seems to be about execution.
How so?
DeepSeek's success suggests that adaptive models, ones that can be fine-tuned quickly for specific tasks and deployed efficiently, are currently leading the pack in these really dynamic trading environments.
So nimbleness beats sheer size in this case.
It looks that way.
That-
And the implication is significant. If the best tools are built on open source foundations, it potentially democratizes access. You might not need a giant closed-off proprietary system like the ones that actually underperformed here.
That could mean a future where smaller, more specialized AIs developed by smaller teams could potentially outperform the tech giants.
Precisely, because they're built for speed and focus in a specific domain, like trading, rather than trying to be an AI that knows everything about everything.
Okay, the results are exciting, definitely instructional, but there's a flip side, isn't there? This experiment also highlighted some pretty serious risks.
Yeah, it's not all champagne and profits in the alpha arena. We have
Yeah.
to talk about the hurdles and the potential dangers this exposed.
Because if these things can generate huge gains with $10 EA, what happens when they're managing billions?
That's the multi-billion-dollar question, isn't it? The potential for systemic risk is enormous. The Federal Reserve actually put out warnings this year, 2025, estimating something like a 15% risk of algorithmic cascades.
Algorithmic cascades?
Hmm.
What does that actually mean? How would that play out?
Imagine one bot, maybe it has a glitch or gets faulty data, places a massive incorrect sell order.
Okay.
Now, other high-speed trading AIs, like the successful ones in this experiment, are programmed to react instantly to market movements. They see that huge sell order, interpret it as a real market shift, and start selling too.
Piling on.
Exactly. It snowballs. A cascade of automated selling triggered by an initial error, potentially crashing the market in seconds.
That's terrifying. And if these AIs are learning from complex data, couldn't they also learn biases?
Absolutely. That's another major concern highlighted by the sources. Research out of Berkeley this year points to persistent biases creeping into these trading models.
Like what kind of bias?
Well, the data suggested DeepSeek, for instance, might have shown a slight, perhaps unintentional preference for trading Chinese or related assets.
Okay. Maybe not harmful at $10, but if it had billions.
Right. That subtle bias, scaled up, could start to significantly distort market prices for those assets. The Berkeley researchers are strongly recommending mandatory audits for financial AIs to catch and mitigate these kinds of biases before they become systemic problems.
Which sounds like we need regulations like yesterday. But government bodies, the SEC and others, aren't exactly known for moving at lightning speed, especially with tech.
And that's the regulation lag problem. Alpha Arena basically throws down the gauntlet. We need new rules, new frameworks that can somehow balance encouraging this kind of innovation because it is powerful with protecting investors and the market stability.
Are there any models for that kind of regulation?
People are looking closely at things like the EU AI Act that came into force in 2024, trying to adapt principles from that to the specific challenges of autonomous finance.
And one last challenge. Even if DeepSeek's code is open source, does that really mean anyone can use it? Isn't there still a big barrier to entry for, say, a small investor?
Huge barrier. Absolutely. The blueprint might be open, but actually training and running these sophisticated models, that takes serious computational power.
Serious hardware, serious data.
Exactly.
Yeah,
You need access to massive data sets, specialized hardware like GPUs.
yeah.
It creates a new kind of digital divide.
Hmm.
Just because the code is free doesn't mean it's accessible.
So how do we democratize this? How do average people benefit?
That's the critical question. We need ways to bridge that gap, maybe through platforms or simplified tools. Otherwise, we risk a future where only the tech elite or large institutions can truly leverage these powerful AI financial tools.
So wrapping this up, Alpha Arena feels like, well, like you said, a teaser. It's exciting, definitely teaches us a lot, but it's also, frankly, a little bit scary.
Yeah, a little terrifying feels about right. It's undeniably accelerating how AI and finance are merging, maybe faster than anyone anticipated.
And forcing us to confront some big questions.
Big questions indeed. Because look at the results. The aggressive risk taker, DeepSeek, won big. The cautious risk minimizer, Claude, also turned a solid profit.
While the established giants, ChatGPT and Gemini, tripped up on overconfidence.
Exactly. So knowing that and considering all the risks we just discussed, the potential for cascades, the hidden biases, the access issues, it leads to a really crucial final thought for you, the listener.
What's that?
If you were going to trust an AI with your money, what criteria would you actually use? It's clearly not just about the highest potential return anymore, is it?
No, it sounds like you need to think about its strategy, its biases, the risks it takes.
Its transparency, its potential systemic impact, it's becoming a complex decision, weighing ethics, risk tolerance, and technical understanding, not just looking at a flashy ROI number from a 3-day experiment.
What algorithm do you trust? That's the question Alpha Arena leaves us with.